So Pillar 2 is here, it's live, and in a financial reporting context is relevant for all in-scope groups. My name is Conor, and together with my colleagues Jacinta and Susan, we're going to bring you through some of the key things we're seeing when it comes to financial reporting in Pillar 2. So first of all, from an FY23 perspective, looking back, it's mostly done at this stage. A lot of people would say that was a relatively benign disclosure requirement when it comes to Pillar 2. Jacinta, what do you say?
Quite go that far. Certainly those disclosures would have been quite concise, but there would have been a lot of work behind the scenes for those groups reporting under IFRS to be able to quantify perhaps the potential materiality impact or how the ETR might be affected, which territories might have top-up tax to pay. And certainly for non-calendar year-end groups, that work is upcoming for those. And then depending on the year-end, you might actually be in that process now of looking live at what your Pillar 2 liabilities are for the year.
The position's a bit different as well for US GAAP filers, and that can include some of the Irish headquartered groups. So for those groups, they probably got away with not doing a detailed disclosure for 23, but quarterly reporting is now coming at them pretty quickly, and there's a need to actually quantify the taxes for that purpose. Part of that for those groups is reliance on country by country safe harbours in various jurisdictions. That can alleviate the complexity, but work needs to be done to make sure you can actually qualify for that safe harbour.
Yeah, and look, overall, I'd say there's an awful lot going on here, right? There's a lot of new rules, and having the resource and time capacity to be able to deal with these and address queries that come from auditors is really important, and it's something that finance teams need to be able to budget for. I think, moreover, when it comes to Pillar 2, it's important to get value for tax attributes, and in the context of, say, losses forward or interest expenses carried forward, making sure that that value isn't lost is really important. That can be addressed by either making sure the relevant amounts are recognised in a formal deferred tax asset, or if not, that there is a relevant disclosure included in those financials.
And we definitely see that being something that groups are paying a lot more care and attention to. It might have been overlooked in previous periods, but they don't want to lose that opportunity to be able to get that value in a Pillar 2 world. And again, it might be this sort of set of accounts that will be the relevant ones for that recognition or disclosure, or it might be an upcoming period, depending on which transitional rules they're looking to apply.
There's an opportunity there to actually add real value as well. So if you take an Irish company paying tax at 12.5%, if they have losses forward coming into Globe, there's actually an ability in the Globe rules to recap those up to 15%, but only in certain circumstances. And the rules are quite tricky. So taking the time to work that through and seeing if you can avail of it is very important.
And looking at not just group accounts as well, which have had the spotlight at the start of the year, but also our Irish individual entity accounts is going to be very important too for that recognition piece, or Pillar 2 overall. So for a lot of our Irish companies, they're going to be calculating their Pillar 2 liabilities based on the profits and the taxes that are in their individual entity accounts.
Indeed, right, but there is that landmine there as well, insofar as to be able to use your individual entity accounts, you need to make sure that the accounting periods of all of the entities in that jurisdiction are aligned, and to the extent there's any misalignment, it actually pushes you back up into the parent entity's financial accounts, which can give you a very different tax answer ultimately. So look, we've been through an awful lot of what we're seeing when it comes to financial reporting, but you may be seeing other things. If you have any questions on any of this or anything else, please feel free to reach out to any of us three or your usual KPMG contacts.